All right, welcome to Talk Tickers. Let's dive straight into a pretty significant one today. The first quarter 2025 earnings call for Milrose Properties.
Yeah, this is a big one. Their first call as a standalone public company, after spinning off from Lennar Corporation.
Exactly. And from the sounds of it, they really hit the ground running. Seemed like a strong start right out of the gate.
Definitely seemed that way. They put up some solid numbers for Q1 25, especially for a debut report.
Okay, so let's not bury the lead. What were the key figures that jumped out?
Well, net income attributable to common shareholders, that was $64.8 million.
Okay.
And if you adjust for some of those pre-spin expenses, it works out to 39 cents per share.
Got it. And the core revenue stream, the option fees.
Option fee revenue came in at $82.7 million for the quarter. Pretty central to their model.
And looking at the balance sheet side, book value?
Book value per share ended the quarter at $35.40.
Okay. And they started paying a dividend too, didn't they?
They did. An inaugural dividend of 38 cents per share. But they were quick to point out, and this is important.
It was prorated.
Exactly. Because of the timing of the spinoff. On a normalized full quarter basis, that 38 cents is actually equivalent to 65 cents per share.
Right. Okay, that makes a difference. So a positive report overall definitely sounds like it, and consistent with them bumping up their guidance too.
Absolutely. Signals real confidence from management, I think, in how things started and what's in the pipeline.
So before we get too deep into the quarter's specifics, maybe we should just quickly level set on how Milrose actually operates, because it's different.
It really is. What's interesting is they're the first, publicly traded land banking REIT. Their whole purpose is providing capital, right, for land acquisition and development, but for home builders.
Through that home option purchase platform.
Yeah.
The just-in-time thing.
Yeah, that's the concept. It lets builders get home sites delivered just when they need them without tying up their own capital for years.
Okay, so crucially, they're not buying land, hoping it appreciates, right? Not speculating.
No, precisely. Their income isn't really tied to land value swings or, the risk of actually doing the development work, putting in streets, utilities, all that.
So where does the revenue come from?
It's mainly those predictable, recurring, monthly option fee payments on the capital they've put out. Think of it like earning a yield, a steady yield, on the money they've committed to the builder's land pipeline.
So they're like a capital partner providing financing on the land, essentially, and earning a fee for that option the builder holds. That feels like a very different risk profile compared to actually owning and developing the land itself.
It is, yeah. It's focused on that yield from the capital provided, which kind of insulates them from some direct development headaches.
Okay, makes sense. Now, obviously, given the spinoff history, the relationship with Lennar is pretty central.
Oh, absolutely. Lennar is the anchor tenant, the foundation. As of March 31st, they had something like $6.6 billion in assets tied up in purchase option agreements just with Lennar.
And the yield on that?
The weighted average yield on that specific Lennar portfolio was running at 8.5%.
Got it. And they mentioned something about capital recycling within that Lennar relationship on the call. What does that actually look like?
Yeah, so in Q1, just in those 3 months, they got $645 million back in cash from Lennar when Lennar exercised options and bought home sites.
Okay.
And then almost straight away, they redeployed $635 million of that, so pretty much all of it, back into funding new land deals and development with Lennar.
So it's like a constant flow, a loop almost. Capital goes out, comes back when home sites are bought, then goes back out again for new deals, keeps the money working with their main partner.
Exactly. So this conveyor belt of capital, keeping that core relationship humming.
That Lennar piece is clear, but a huge part of the story now has to be growing beyond Lennar, right? Building out relationships with other builders. How's that going?
Yeah, that's key for the growth narrative. And they showed pretty significant progress there. They've already locked in 5 separate programmatic partnership commitments with builders other than Lennar.
Programmatic, meaning like ongoing frameworks, not just one-offs.
Right, setting up repeatable structures, and the actual deal volume outside Lennar in Q1 was $351 million.
Okay, that's substantial. And the yields on those deals?
That's the interesting part. They came in higher, on average around 11.7%.
Yeah.
So better returns on that non-Lennar capital.
And that momentum continued after the quarter ended.
It did. They made a point of saying that between March 31st and the date of the earnings call, they stacked up another roughly $130 million in non-Lennar transactions.
Wow, okay, so add that to the Q1 number.
Yeah, it brings their total cumulative funding outside Lennar, just since the spinoff, to about $480 million. That's pretty fast growth in building new partnerships.
And this leads into maybe the biggest news from the call is this huge new commitment they announced. Really highlights their kind of strategic potential.
Absolutely. They committed to funding approximately $700 million, a really big number in a traditional land banking structure. This is in partnership with the new home company.
And the reason was specific, right? It was tied to an acquisition.
Exactly. It's to help new home company acquire land homes.
So wait, they're not just funding everyday land buys, they're stepping in to actually help facilitate M&A deals in the home building sector?
That's precisely it. It's similar to what they did, with the Rouge Coleman deal earlier. This $700 million commitment shows how Milrose's capital can be a tool, like you said, to enable these big strategic moves, like one builder buying another, without the buyer having to put all that land onto their own balance sheet immediately.
So how does that $700 million break down?
The plan is about $600 million for the actual land acquisition, which they expect to fund in Q3 of this year, 2025. And then there's another $100 million earmarked for funding the land development on those sites later on.
Okay, that kind of firepower, especially facilitating a deal like new home buying land, that must have factored into their outlook for the rest of the year.
Oh, definitely. Based on this momentum, the size of deals like this, and their pipeline, they actually increased their full year 2025 guidance.
For the non-Lennar funding.
Yeah. They bumped up the target for transaction funding outside the Lennar agreement from $1 billion originally up to $1.5 billion now.
That's a 50% increase.
It is. And management even mentioned, sort of informally, an internal stretch target of $2 billion. So they clearly see potential for even more upside if things keep clicking.
And hitting those higher funding numbers, what does that do to their earnings expectations?
Well, naturally it led them to raise guidance there too. For the year-end quarterly earnings per share run rate, they're now forecasting a range of 69 to 71 cents per share. That reflects the impact of deploying more capital at those attractive non-Lennar yields.
Makes sense. Now, to support that kind of growth, especially if they're aiming towards, maybe even that $2 billion stretch target, they need the financial capacity. What did they say about the balance sheet and liquidity?
Balance sheet looks pretty solid. They reported $7.2 billion in total assets. And importantly, their debt to capitalization ratio was very low at the end of Q1, only about 5%. Total debt was around $350 million.
So not much leverage right now. What about readily available funds, liquidity?
They have plenty, roughly $1.1 billion in liquidity, and that includes cash on hand, plus what's available under the revolving credit facility.
And didn't they just add even more borrowing capacity?
They did, yeah. Big announcement there, too. They signed a new $1 billion delay draw term loan commitment with Goldman Sachs and JP Morgan.
Okay.
They mentioned it has similar terms to their existing revolver. So this adds significant firepower for future funding needs, especially when you consider their stated maximum leverage target is 33% net debt to capitalization.
Right. So they have a lot of room to add debt and fund deals before hitting that ceiling.
A considerable amount of room, yes.
Okay, so they're deploying more capital, expanding outside Lennar, often at higher yields. How are they thinking about underwriting? Are they taking on more risk, or how are they managing that?
Management was pretty clear that the underwriting process remains rigorous. They stressed it's not just about the builder's creditworthiness. They're doing deep dives on the actual real estate, the specific land involved, and really kicking the tires on the builder's assumptions about gross margins and selling prices for those projects and making sure they seem realistic.
And for the non-Lennar deals, are there extra protections?
Yes, they specifically mentioned features like cross-collateralization, where different projects might secure each other, and also requiring higher deposits compared to what's typical in the Lennar Master Agreement.
And builders are okay with that? Higher deposits and maybe slightly lower effective yields?
Apparently so. Milrose presented it as builders seeing the value and the flexibility and the balance sheet relief Milrose provides, so they're sometimes willing to offer those enhancements. Milrose sees that as a positive for managing risk, naturally.
Got it. There was also an interesting point about the duration or the life of these non-Lennar deals. It sounded like the final contract end date isn't the whole picture.
That's right. They clarified that, the maximum contract term for the very last home site to be bought might stretch out, maybe 50 months or something in some cases, but the weighted average life of the capital they have outstanding is actually much shorter.
Because the builders are buying lots incrementally along the way.
Exactly. As builders draw down home sites and pay fees over time, Milrose gets its capital back sooner and earns the yield faster than that final contract date might suggest, maybe closer to half that maximum duration on average. They seemed comfortable with that, and also noted that new deals with Lennar are often focused on even shorter-term stuff, like work-in-progress inventory.
Okay, so let's bring this back to you, the listener. Milrose's story here, their performance and strategy, it really plugs into some bigger shifts happening in the housing sector.
Yeah, they highlighted several sort of durable tailwinds that they see supporting their business.
Like the basic fact that we just don't have enough houses.
Absolutely. They talk about that structural deficit you hear, numbers like 3 to 5 million units short in the U.S. And a big driver of that is how hard it is to get permits and entitlements for new projects.
Yeah.
That basic shortage fuels demand for new construction.
And there's also the dynamic between new homes and existing homes changing, right?
Correct. With interest rates where they are, a lot of current homeowners have these super low mortgage rates they don't want to give up, the lock-in effect.
Right.
So fewer existing homes are being listed, which means the new home market is actually capturing a bigger slice of the overall sales pie. That's good for builders.
Yeah.
They also pointed to, the big builders getting bigger, consolidating, benefiting from scale advantages, and also just more builders, generally big and small, trying to adopt these just-in-time land models, these land-light strategies, to make their balance sheets more efficient.
And Milrose is positioning itself right in the middle of that, aren't they? As a solution provider, a tool in the toolbox, as they put it, for builders trying to navigate these trends.
That M&A facilitator role is a perfect example. We talked about Rush Coleman and now this massive new HomeLink deal. It shows how their capital can unlock these big strategic moves for builders, letting them grow or buy assets without getting swamped by land costs up front. They mentioned they're having more conversations with mid-market builders looking for similar solutions too.
And their dividend policy, that's another pretty distinct feature, paying out 100% of earnings.
Yeah. They plan to distribute essentially everything back to shareholders. As a REIT, that's tax efficient, of course. Their reasoning was that, retaining just a small sliver of earnings wouldn't really move the needle much, given the size of their balance sheet and borrowing capacity anyway.
So better to just return it all directly.
Right. Maximize the effective yield going straight back to shareholders. Seems to be their focus.
All right, let's switch gears now. Time for our not financial advice segment. Based purely on the commentary from this earnings call, let's toss around some, let's call them outrageous but plausible speculative ideas. Just thought experiments, remember?
Okay, idea number 1. This one leans into management's own ambition.
The pitch. Go along, Milrose, but not just assuming they hit their raised $1.5 billion non-linear funding guidance. Bet that they absolutely smash past their internal $2 billion stretch target this year.
Okay, why? What's the rationale?
The thinking is that this M&A tailwind, the trend of builders needing capital partners for big deals, is even stronger and moving faster than anyone's modeling. Milrose's role as the go-to facilitator gains traction super quickly, leading to maybe multiple large deals like the Lank one landing much sooner than expected.
And the outrageous part of that.
Just the sheer speed and scale required. Hitting or significantly beating $2 billion in new non-linear funding just this year, 2025, would mean executing a lot of deals, potentially several large M&A-related ones, way ahead of the official guidance pace. But the plausible side...
Well, they're clearly set up for this M&A role. They just proved it with a $700 million commitment for one deal. They explicitly said activity and conversations are increasing, including with mid-market builders. If just one or maybe two more big M&A deals or large programmatic partnerships come through this year, suddenly $2 billion doesn't seem quite so crazy. And that would drive EPS and potential dividend growth much faster than the market expects right now.
Okay, interesting. Idea number 2 plays on the broader industry shift.
Right. Pitch. This is a paired trade. You short shares of a traditional home builder, one that seems maybe stuck with a lot of land on its books, isn't visibly embracing land light, and isn't partnering up with folks like Milrose. And at the same time, you go long Milrose.
The underlying bet here is
that the shift to land light is accelerating dramatically. As capital partners like Milrose make efficient funding more available, builders who don't adapt, who keep tying up huge amounts of their own capital in land, start looking competitively disadvantaged. Maybe slower growth, lower returns on capital, less M&A flexibility.
And the outrageous part of this one.
Assuming the market reacts quickly and punishes those perceived non-adopters really harshly, you'd need a pretty sharp divergence in stock performance between the old model builders and the land-light enablers like Milrose for this trade to work out spectacularly. But the plausible angle.
It's that strong secular trend they talked about on the call. If land light truly becomes the industry standard, the market could very well start drawing sharper distinctions. Balance sheet strategy and capital partnerships could become key differentiating factors for investors.
Makes sense. And just to hammer it home again, folks, those were purely speculative ideas based on the call commentary. Definitely not financial advice.
Absolutely not. So wrapping this up, it sounds like Milrose Properties had a really solid first quarter out of the gate as a public company.
Yeah, navigated the spinoff well, showed real momentum building that business outside the core Lennar relationship. That new home length deal is a major proof point.
And all that performance and the strong pipeline led them to boost their guidance for the full year. They seem well capitalized to chase that growth, and they've carved out a pretty clear niche for themselves, facilitating land light strategies and M&A for builders.
Again, this deep dive was purely for informational purposes, not investment advice.
So maybe a final thought for you, the listener, to chew on. Given Milrose's focus on generating predictable cash flow from those option fees and their unique role helping builders go land light and do deals, how do you think a business like this might hold up in different kinds of markets? Say, if interest rates shoot up again, or if the housing market cools off significantly, how might it compare to a traditional builder holding lots of land?
And what does that 100% dividend payout policy really tell you about their priorities? Is it all about returning capital now, or do they see growth funded primarily through leverage and capital recycling? Lots to think about there.
Definitely. We encourage you to keep exploring these ideas and how these shifts might reshape the whole home building landscape.